Hey guys, Dimitri Pergamonic with MarketChameleon.com. Nike is coming out with earnings later today after the close, and an interesting question came up. Looking at the options, how do you evaluate an option when you're looking at it on the board? So I'm just going to pick one as an example here, the 84 put, which is below the current stock price of 87.88. And really the question is, historically, how often would this put result in a profit if you did it with the same kind of conditions as now? So we have one trading day to go. These options will expire tomorrow, and we have earnings coming up. So under those conditions, how frequently did this option result in a profit, and by how much? How many times did it result in more than 72 cents, for example, or how many times did it result in a worthless option the next day? So let's just go in there and take a look at this analysis and see what we get. So I'm just going to pop open a diagram here at expiration. This is basically how the option profit and loss would look at expiration. But let's just take a look at the theoretical value of that option. And I'm going to set this for 10 years of history, and I'm only going to look at earnings periods. So what this is going to do is just look at 10 years of history just around earnings for this one day. And now going down to the data, I'm going to just open this up. We see that over here, the option fell below 4.4%, which is where this strike is, 4.4%. It fell below 4.4%, 13% of the time. So 13% of all our data showed that after earnings, the one day, it would have resulted in the stock falling below that strike price, and it was above that strike price 87% of the time. So we have 39 observations, and these are the statistics, and these are the average returns when it fell below 4.4%. These are the average returns when it was above the 4.4%. So let's just kind of take a look at the data really quickly, and I'm going to sort here by the highest theoretical value. So here, for example, in June 2012, we see the one-day move was negative 9.4%. And what that is saying is if we replicated that move, right, the stock price right now, let's take a look, is 87.88. If it fell 9.4%, that would put us at 79.58. So theoretically, if that's what happens, then our option, right, our option would be worth $4.42. Or we could see that the 84 strike, the stock price would will fall, go right through it. It would stop at, for example, 79.58. That would make that option worth $4.42. And here you have, the highest prices that it ended up, and you could see a lot of times the stock either didn't go down far enough or it finished up, that these options ended up being worthless for a one-day move. So given this market, 72 cents, 76 cents, what do we think theoretically it's worth? Well, given this history, if we did this trade over and over and over again for 72 cents, and in theory, if the price distribution looks similar to what it did in history, of course there's no guarantees, we're just trading ideas here, then over time this option would be worth 33 cents. So you'd have some losses, but you'd have many wins. And theoretically, if you did it for 72 cents under similar conditions over and over, then it would have resulted in 89.7% of the time, it would have resulted in a profit, or even by penny, whatever profit it is, 89.7% of the time, it would have resulted in a profit. And that would be your theoretical edge, given that if we have it worth 33 cents, you could sell it here, and that's your theoretical edge. So let's look at another scenario here. That's one option. What if we did a strangle, for example? We'll sell one of these, and then maybe we sell one of these. We do a strangle around there. So that's what the strangle looks like at expiration. The P&L, let's take a look at the theoretical value for that over the last 10 years. We'll do the same thing. Look at 10 years history. We're only going to look for only earnings periods. We're going to reload it. And here we have it. So theoretically, we have it worth $1.39 using that history. And if you compare it to the current market, it would have resulted in 69.2% win rate historically. And that would be the theoretical edge compared to the theoretical value versus the market. Thanks for watching, guys, and appreciate all the emails you guys give. Talk to you guys later.